The great popularity of ETFs has recently surpassed other investment assets and is of great interest to the general public. People see ETF investing as an opportunity, the ease of buying, similar to buying shares, higher levels of diversification, spreading risk into different assets, locations, company sizes, or into basket of dividend-paying companies. I summarized the main benefits of investing in an ETF fund in a recent video linked here. Did you know that ETFs can pay dividend? That is a share of the profits of the companies they have purchased. The dividend is paid either quarterly, annually or monthly. We will be interested in ETFs that pay dividends monthly. In order to have better control over the cash flow of our investment, an ETF paying a dividend on a monthly basis will be an ideal candidate for our purpose. Welcome to my channel Invest with Jiri. Today we will take a look at 3 ETF funds that pay a regular monthly dividend. We will explain what to look for when choosing one and we'll cover some basic information on each ETF. The intention of my selection was that you could buy all 3 ETFs and they would complement each other to create the ideal dividend portfolio. Finally, we calculate how much money we would need to invest in the mentioned ETFs for a monthly income of $3,000. So there's definitely something to look forward to. Why monthly dividend ETFs? If we have invested in an ETF that pays a monthly dividend, we can either pay the dividend regularly into our bank account or, then that's the better way, reinvest that dividend. That is to buy either another ETF or another instrument such as a particular stock. This gives us the opportunity to actively influence the development of our portfolio on a monthly basis according to the market situation. Choosing a particular ETF is not an easy matter. We have to sift through several thousand ETFs issued by the best-known companies such as State Street, Global Advisors, Vanguard Group or BlackRock, and find among them those that pay a monthly dividend. Next, we need to look at the expense ratio, the annual cost of managing the fund, which can significantly affect the performance of our investment. Find out the size of the fund, the bigger is safer, where it invests, whether in stocks, bonds, REITs, etc. And find when the fund was established. Longer history is better, of course. When choosing appropriate ETFs, one will come across funds that offer a high dividend yield but are unable to sustain it over the long term, or funds investing with leverage that can be beneficial when markets are going in the right direction or liquidating when things go wrong. We should be particularly wary of these funds, and if we are serious about long-term investing, we should avoid them. The first of the ETFs in my selection is the Global X Super Dividend Fund with symbol SDIV. It tracks an index of 124 equal weighted companies that have the highest dividend yields in the world. The fund includes common stocks but also REITs that invest in real estate and Master Limited Partnership MLPs that invest in low-cost assets. The fund has paid dividend for 9 years in a row. I choose it because of its high diversification and international asset overlap. And let's face it, its dividend yield of 13.23% is the best among ETFs in the context of quality, size and fees. Here you can see some of the largest holdings with percent weight around 1.5%. The second fund is the Global X US Super Dividend Fund with symbol DIV. It invests in a basket of securities with low volatility and high yield. It aims to track the performance of 51 equally weighted stocks, MPLs, and REITs with a US location. The assets included in the index are among the highest yielding in the United States and have lower relative volatility than the market. The fund can be combined well with the previous SDVI index for investors who want a global portfolio of high-yielding stocks, both in the US and around the world. Here you can see some of the largest holdings with percent weight around 3%. The third candidate for the monthly dividend ETF pick is the Invesco Preferred Fund PGX, which replicates the performance and yield of the ICE B of AML Core Plus Fixed Rate Preferred Securities Index. Its portfolio includes over 293 preferred stocks with a heavy weighting in the financial sector. The bulk of the investments are in BBB-rated holdings. Why did I choose it? PGX has a high net assets, $4.89 billion, broad diversification into the aforementioned 293 stocks, and is ideal as a complement to the SDIV fund investing in US equities. Here we can see some of the largest holdings with percent weight around 1.4%. All three ETFs have net assets between $700 million to $4.8 billion and a very low expense ratio between 0.45% to 0.58%, a dividend yield between 5.77% and 13.23% per annum. The funding of the funds is between 2008 to 2013, appropriate mix of global and US equities. In conclusion, let's figure out how much money we need to invest to receive $3,000 per month in dividends for these three ETFs. The average dividend yield for selected ETFs is 8.6% per year, meaning we need to invest $420,000 for a monthly dividend of $3,000. Of course, that's not counting the increase in the ETF's price over time when they are sold. I think this is a very interesting way to safely put your money in quality funds at a reasonable annual fee, while still having the possibility of regular dividend income. All this in the context of global investing. What more could you ask for? If you are interested in investing, check out my Patreon in the video description, and if you enjoyed today's video, please give it a like, and I look forward to seeing you in future videos. Have fun and invest wisely.